Hey everyone, welcome back to our channel where we delve into the secrets of financial success and teach you how to use compounding to build wealth. Today, we're diving into a fascinating topic, how to get rich using compounding. If you're eager to learn the strategies and steps for achieving financial freedom, hit subscribe and let's jump right in. But first, let's break down what compounding is and how it can pave the way to wealth. Compounding is essentially making money on your money. It's like a snowball rolling down a hill, getting bigger and bigger as it goes. The more money you have, the more you earn, and the longer you let it grow, the bigger it becomes. Compounding is a powerhouse in finance, capable of significantly boosting your wealth over time. And it's not just talk. Have you ever seen compounding in action in your own life? Maybe you've watched your savings grow in a bank account thanks to interest, or seen your investments increase in value in the stock market. Or perhaps you started a business and reinvested your profits to fuel its growth. We'd love to hear your experiences, so share your story with us in the comments below. Now that you know what compounding is, let's see how it plays out in real life. Time is a big deal when it comes to compounding. The longer you let your money grow, the more powerful compounding gets. That's why it's super important to start investing as soon as you can. Let's imagine a story about two friends, Alice and Bob, who both decide to invest some money. Alice starts putting $2,000 into her investment account each year when she's 25 years old. She does this for 10 years until she's 35, and then she stops adding money, but lets her investment grow on its own. Bob, on the other hand, starts investing the same amount, $2,000 per year. But he starts later when he's 35. He continues this for 30 years until he's 65, and then he stops adding money too. Now, both Alice and Bob's investments earn them an average of 8% return every year. This means their money grows over time. Now, who do you think will have more money by the time they're both 65 years old? If you guessed Alice, you're correct. Even though Alice invested for only 10 years compared to Bob's 30 years, she ends up with more money because of something called compounding. Compounding means that her money had more time to grow and make even more money on top of itself. So by the time they're both 65 years old, Alice has $372,000, while Bob has $279,000. That's a big difference of $93,000. And remember, this is assuming they both earned the same rate of return. If Alice had earned a higher rate of return than Bob, the difference would be even bigger. Now that we've explained how compounding works, let's dive into how it can really boost your wealth. We'll explore two real-life situations, investing a big chunk of money all at once and investing regularly over time. Later on, we'll also discuss 3 key assets that can help you capitalize on compounding to build wealth. So stay tuned. First up, let's tackle the lump sum investment approach. This happens when you have a hefty sum of money that you want to invest for the long haul. It could be from an inheritance, a bonus at work, or even a lottery win. How can you harness the power of compounding to accelerate the growth of your money? Let's walk through an example to find out. Let's say you have $50,000 that you want to invest for 30 years. You find an investment option that gives you an average annual return of 10%. How much do you think your $50,000 will grow to after 30 years? Take a guess and let us know in the comments below. The answer is pretty impressive. $863,000. Yes, you read that right. Your initial investment of $50,000 could balloon to almost $1 million in 30 years. That's the magic of compounding. By letting your money earn interest on top of interest, you can see your wealth grow exponentially over time. Now let's shift gears and talk about investing through regular contributions. This means you save and invest a set amount of money every month or every year. For instance, let's say you can afford to set aside $500 from your monthly budget for investing. How can you use compounding to turbocharge your money's growth? Let's check out another example to find out. Let's imagine you start putting away $500 every month for 30 years. You find an investment that gives you an average annual return of 8%. How much do you think your monthly contributions will grow to after 30 years? The answer is pretty incredible. $1.1 million. Yes, you read that right. Your $500 per month investment could swell to over $1 million in 30 years. That's the power of compounding. By consistently adding money to your investment and letting it earn interest on top of interest, you can see your wealth multiply exponentially over time. These examples show how compounding can boost your wealth, whether you invest a big chunk of money up front or make regular contributions over time. Compounding can really change the game on your path to building wealth. But how exactly can you use compounding to invest in different assets? And what are some of the best assets that can help you get rich with compounding? Let's dive in. One of the top assets that can help you capitalize on compounding is mutual funds. Let's delve into mutual funds, asset that can help you tap into the power of compounding. Mutual funds offer a convenient way to invest in a broad range of assets managed by professional fund managers. But what exactly are mutual funds? Picture them as a pool of money gathered from various investors, which is then used to invest in a mix of stocks, bonds, or other securities. When you invest in a mutual fund, you're essentially getting exposure to a diverse portfolio of assets without needing to buy each individual investment separately. In other words, a mutual fund lets you own a bunch of different assets with just one purchase instead of having to buy each asset one by one. Why should you consider investing in mutual funds? Let's explore how compounding works with mutual funds. When you put your money into a mutual fund, you can choose to reinvest any dividends and capital gains you earn. By doing this, you're letting your profits generate even more profits over time, thanks to the magic of compounding. Now let's talk about systematic investment plans, SIIPs, which are a special feature offered by mutual funds. SIIPs allow you to invest a set amount regularly, like every month or quarter, no matter what the market is doing. This disciplined approach not only lets you take advantage of market ups and downs, but also ensures that you stay invested for the long haul, so you can fully benefit from the power of compounding. Let's break down how systematic investment plans, SIIPs, work with mutual funds in simple terms. Imagine you decide to set up a CIP to invest $100 every month in a mutual fund that you like. This means you're committing to investing the same amount regularly without worrying about trying to time the market or missing out on opportunities. With a SIP, you benefit from something called dollar cost averaging. This means you buy more shares when prices are low and fewer shares when prices are high. Over time, this can help smooth out the ups and downs of the market, potentially reducing your overall risk and boosting your returns. Before you dive into investing in mutual funds, there are a few things to consider. First, take a close look at the fund's investment strategy to make sure it aligns with your goals. Then, check out its past performance to get an idea of how it has done in different market conditions. Lastly, pay attention to the fund's expenses and fees, as these can eat into your returns over time. Remember, investing in mutual funds comes with risks, so it's important to do your homework and make informed decisions. By the way, if you're finding this information helpful and want to learn more about topics like this, drop a comment with the word "more" so I know to keep them coming. Now let's move on to the next asset that can help us become rich with the power of compounding: stocks. Stocks represent ownership in a company. When you buy stocks, you become a part owner of that company and benefit from its growth and success. Let's break down how compounding can work wonders with stocks. When you invest in stocks, there are two main ways to make money: through capital appreciation and dividends. Capital appreciation happens when the stock price goes up over time. Dividends, on the other hand, are payments that companies make to their shareholders from their profits. You can supercharge your returns by using compounding to reinvest your dividends. Here's another example to illustrate this. Imagine you invest $10,000 in a stock that pays a 3% dividend yield each year. If you reinvest those dividends and assume a 10% annual return over 20 years, your investment could grow to almost $53,000. But if you don't reinvest your dividends, your investment would only reach about $38,000. That's a big difference. So how does reinvesting dividends affect your investment returns? When you reinvest your dividends, you're plowing your earnings back into your investment, allowing them to earn even more interest over time. This compounding effect can significantly boost your overall investment returns. As you can see, stocks are one of the top assets for harnessing the power of compounding. Remember, compounding in stocks comes from two main sources: capital appreciation, the increase in stock price over time, and dividends, the periodic payments from companies to their shareholders. Let's imagine you put $10,000 into a diverse mix of stocks, and they grow by an average of 10% each year. After 10 years, your initial $10,000 investment could be worth around $25,937. But here's where it gets even more exciting. If you keep reinvesting the dividends you earn, your wealth will keep on growing. Reinvesting dividends is like supercharging your investment with compounding. Instead of pocketing the dividend payments, you use them to buy more shares of the same stock. As your investment grows, so do the dividends, giving you even more shares. This cycle has a compounding effect, meaning your money grows more and more over time. Now, let's say the stocks in your portfolio pay an average dividend of 3%. Your money could grow even faster if you reinvest those dividends. If you assume a 10% yearly return over the next 20 years, your initial $10,000 investment might balloon to around $67,275. Now imagine this. What do you think would happen if you put in more money up front or kept investing for a longer period? Share your thoughts in the comments below. Let's talk about how real estate investment can help you build wealth through the power of compounding. Real estate is another way to benefit from compounding. When you own properties and earn rental income from them, you can use those profits to buy more properties over time. As your real estate portfolio grows, so does your cash flow and your overall wealth. Here's an example to illustrate this. Say you invest in a rental property that brings in $1,500 per month in rent, but after expenses and mortgage payments, you're left with $1,000. If you reinvest that extra $500 each month to buy another property, you can quickly expand your real estate holdings. As you acquire more properties and increase your rental income, the power of compounding starts to work its magic, doubling both your wealth and your cash flow over time. Have you ever thought about investing in real estate? Feel free to share your thoughts and experiences in the comments below. Real estate is a powerful way to reach your financial goals. It can provide you with a steady income from rent and also increase in value over time. But here's the kicker. You can turbocharge your wealth by reinvesting your rental income into more properties. This strategy can help you build a real estate empire that generates passive income and wealth for you. A prime example of someone who has mastered this strategy is Donald Bren, the richest real estate billionaire in the country with an estimated net worth of $16.2 billion. He's the chairman and owner of Irvine Company, a private real estate investment company that owns and manages office buildings, apartments, hotels, golf clubs, marinas, and shopping centers in California. His success shows just how powerful real estate can be as an investment vehicle for creating wealth. Let's break down Donald Bren's journey. He started with a small loan and a big dream. Using the money he made from his early ventures, he kept buying more land and working on new projects. Instead of focusing on quick profits, he aimed to build properties that would last and add value over time. He wasn't just interested in buildings. He wanted to create communities where people could live, work, and enjoy life. Donald Bren's story teaches us that reinvesting your rental income can be a game changer in growing your real estate portfolio and reaching financial independence. He's a role model for anyone who dreams of following in his footsteps and becoming a successful real estate investor. His story shows that with hard work, vision, and smart reinvestment strategies, anyone can achieve their goals in real estate. Moving on to the next asset that can help us become rich through the power of compounding: bonds. When you buy a bond, you're basically lending money to an organization, like a government or a company. In return, they promise to pay you back the money you lent them, plus some extra cash in the form of interest payments, usually every 6 months. And when the bond reaches its end date, known as maturity, you get back the original amount you lent them. Now, compared to stocks, bonds might not make you as much money, but they're like a steady ship in stormy seas. They provide stability to your investment mix and can be an important part of a balanced investment plan. You can also use the power of compounding with bonds. Here's how it works. Every time you get an interest payment from your bond, you can reinvest that money to buy more bonds. Over time, your investment slowly grows, kind of like a snowball rolling down a hill, gathering more snow as it goes. So what do you think about investing in bonds? Do you see them as a valuable addition to your investment plan? Bonds can bring a nice mix of growth and stability to your investments. And by reinvesting your interest payments, you can gradually grow your wealth over time using the power of compounding. Let's talk about luck and risk in investing. When you invest, there's always a bit of uncertainty and chance involved. Your investment returns can be affected by things like how the market is doing, unexpected events like natural disasters, and how well individual companies perform. While compounding can help you grow your wealth over time, it's important to realize that not every investment will turn out successful. Let me tell you a quick story to illustrate this. Meet Sarah, a smart investor who carefully researches different stocks before deciding where to invest her money. She picks what she thinks are solid businesses with promising futures. But unfortunately, one of the companies she invested in got caught up in a big scandal, causing its stock price to plummet. Sarah's investment took a hit, but she didn't give up. Instead, she learned from the experience and spread her investments across a variety of different assets, which helped reduce the impact if something similar happened in the future. So what's the takeaway here? While compounding can be a great way to grow your wealth, it's crucial to remember that investing also involves luck and risk. Not every investment will go as planned, but by being smart and diversifying your investments, you can help protect yourself against potential setbacks. Let's break down the key lesson here. Investing is like a mix of strategy and understanding the unpredictable nature of the market. One important strategy is diversification, which means spreading your investments across different types of assets, industries, and even countries. This helps lower the risk if one investment doesn't do well. It's also crucial to do your homework by researching investments, staying up to date with what's happening in the market, and being ready to adjust your strategy when needed. While luck can sometimes play a role in how your investments turn out, smart decision-making and diversification are things you have control over. They can increase your chances of success in the long run. If you've got any stories about your own investment experiences, whether they were good or bad, I'd love to hear them. Share your stories in the comments below and let's all learn from each other's experiences. Let's dive into how the compounding effect can transform your personal finances. We've already seen how it works with investments, but it's just as impactful when it comes to managing your money day to day. By harnessing the power of compounding, you can speed up your journey to financial freedom. And there are 3 key areas where compounding can really make a difference: debt repayment, retirement accounts, and savings. First up, let's talk about how tackling debt can help you build wealth through compounding. When you're dealing with debt, interest can really weigh you down. Whether it's student loans or credit card debt, those interest payments can add up fast. But here's the thing, by making larger payments and steadily chipping away at the principal balance, you can shorten the time it takes to pay off your debt and save big on interest in the long run. Let's break down how quickly paying off debt can be a game changer for your finances. Imagine you have a $30,000 student loan with a 6% interest rate, and you're starting with a balance of $30,000. If you stick to just the minimum monthly payments, it could take you more than 20 years to pay off the debt completely, with a ton of interest charges along the way. But here's the kicker. If you bump up your payments and steadily chip away at the principal debt, you can slash that repayment period and save a bundle on interest. For example, by making larger payments and consistently lowering the amount you owe, you could cut down the repayment time significantly. Plus, you'll save a lot of money that would have otherwise gone toward interest payments. If you're currently tackling any debts, remember that you can use the power of compounding to free yourself from financial burdens sooner. Once you're debt-free, you can redirect those funds toward activities that help you build wealth for the future. Let's talk about retirement accounts and how they can help us get wealthy through something called compounding. Retirement accounts are special savings plans that help you save money for when you're older. They give you some nice benefits, like not having to pay taxes on the money you put into them until you take it out when you retire. This means you get to keep more of your money to grow over time. Another cool thing is that sometimes your employer will add some money to your retirement account too. It's like getting a bonus. This extra money helps your savings grow even faster. Here's an example to help understand it better. Let's say you put $500 every month into your retirement account, and your employer adds 50% of that. If your savings grow by 7% every year and you keep adding money for 30 years, you could end up with more than $1.2 million. So retirement accounts are like a secret weapon for building wealth. They help you save regularly, get extra money from your employer, and make your money grow faster over time through compounding. Let's talk about how you can start saving for your retirement and how saving money can help you become wealthy over time. First, it's a good idea to think about how you're saving for retirement. Are you taking advantage of any programs at work where your employer matches your contributions? If so, that's a great way to boost your savings. Now let's focus on saving in general. One powerful tool is something called compounding. It's like a magic trick for your money. When you save money, it earns interest, and then that interest earns even more interest over time. It's like a snowball rolling downhill, getting bigger and bigger. One easy way to start saving is to set up automatic transfers from your checking account to a savings account or an investment account. This way, you're saving money without even thinking about it. Then you can sit back and watch your savings grow through compounding. You can also look for savings options that offer higher interest rates or returns. For example, certificates of deposit, CDs, money market accounts, index funds, or exchange-traded funds, ETFs, are good choices. These options can help your money grow even faster and get you closer to your financial goals sooner. We've talked about how different assets like real estate, the stock market, mutual funds, and bonds can help you build wealth through compounding. But remember, it's not just about what you invest in, it's also about having the right mindset and strategies to reach your financial goals. Now let's get into 5 key takeaways from the book The Compound Effect by Darren Hardy, which can enhance our understanding of compounding and wealth creation. Let's talk about a couple more important points from the compound effect that can help us understand how small actions can lead to big changes. 1. Small steps lead to big wins. The book teaches us that even small actions done consistently can make a huge difference. Every decision you make, no matter how tiny, adds up over time. For instance, if you want to get healthier, you don't have to overhaul your entire lifestyle all at once. Instead, focus on making small, positive choices each day, like doing a short workout or picking a healthy snack over junk food. These small choices may seem insignificant on their own, but when you do them consistently, they add up to better fitness, more energy, and a happier mood. The key is to stick with it and make these small choices every day because it's the cumulative effect that really counts. 2. Measure what matters. Another important takeaway is the need to track your progress. If you want to improve something, whether it's your finances, your health, or any other aspect of your life, you need to measure it. This means keeping track of your actions and the results they produce. For example, if you want to save more money, start by tracking your spending for a month. Write down every purchase you make, big or small. This will help you see where your money is going and where you can cut back. Use this information to create a budget that aligns with your financial goals, and then keep track of your progress as you stick to it. By measuring and monitoring your habits, you can identify patterns, make informed decisions, and stay on track toward your goals. Plus, writing everything down helps you stay accountable and gives you a clear picture of your progress over time. 3. Own your life. This takeaway emphasizes the importance of taking responsibility for our own lives. You have the power to choose your actions and shape your outcomes. Instead of blaming luck or external factors for your successes or failures, take ownership of your decisions. Recognize that you have control over your life, regardless of the circumstances around you. Relying solely on luck or chance isn't enough. You must actively make decisions and take actions that align with your goals. When you take responsibility, you become proactive and solution-oriented. You shift from a victim mindset to an empowered one, actively seeking opportunities and overcoming obstacles to create a fulfilling life. 4. Focus on mastery. Success isn't about trying to do everything. It's about mastering a few key things. Rather than constantly seeking new knowledge, focus on taking consistent action in areas that matter most to your success. Identify these critical areas, whether they're skills, aspects of your business, or important habits, and dedicate yourself to mastering them. Instead of spreading yourself thin, concentrate your time and energy on becoming excellent in these key areas. Continuously refine your methods, aim for improvement, and stick with the actions that yield the greatest results. By doing so, you'll develop expertise, create a solid foundation for success, and ultimately achieve mastery in your chosen areas. Avoid the temptation to chase every opportunity. Instead, focus on the few actions that truly make a difference. By consistently practicing and refining these actions, you'll build momentum, achieve mastery, and set yourself up for long-term success. Let's explore the final lesson from the compound effect, which emphasizes the importance of gratitude. Practice gratitude. This takeaway highlights the power of gratitude in shaping our lives for the better. Gratitude is about recognizing and appreciating the people, situations, and opportunities that have positively impacted our lives. It's not just about saying thank you, but truly acknowledging the support and blessings we've received from others. Gratitude is a transformative practice that not only makes us happier, but also attracts more good things into our lives. When we express gratitude for what we have, we create space for even more abundance to flow in. For instance, take a few moments every day to reflect on the people, experiences, and lessons you're grateful for. It could be a supportive mentor, a caring friend or family member, or the lessons learned from challenging times. By cultivating a mindset of gratitude, we shift our focus from scarcity to abundance. This positive outlook attracts new opportunities and blessings, creating a cycle of gratitude and abundance in our lives. Remember, what you appreciate tends to increase, so make gratitude a regular practice in your daily life. By doing so, you'll not only enhance your own well-being, but also invite more positivity and fulfillment into your life. What a thought-provoking story! It reminds us that true wealth isn't just about having a lot of money, it's about knowing when we have enough. Even though the billionaire hedge fund manager may have made a staggering amount of money in one day, Joseph Heller found contentment and satisfaction in knowing that he had enough. This story teaches us the importance of perspective and gratitude in our lives. It's a reminder that financial abundance doesn't necessarily equate to happiness or fulfillment. Instead, finding contentment with what we have can bring a sense of peace and satisfaction that money alone cannot provide. While compounding can indeed help us achieve financial goals, it's crucial to approach investments with caution and wisdom. Seeking professional advice and being smart about our financial decisions can help us navigate the complexities of investing and ensure that we're making choices aligned with our long-term goals and values. Ultimately, this story encourages us to reflect on what truly matters in life and to find joy and contentment in the present moment, regardless of our financial circumstances. I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching.